Hey everyone, it's Ed Kime from over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and option trading offer, where you get everything we offer on our web tools, along with commission-free trading, for just $99 a month. It's what we use here, and it's what we're going to go through today as we take a look at our current portfolio. Now, it's been a couple weeks, actually been 2 weeks since we last checked in. We've been kind of just letting things sit out and collect a little bit of cash. We had a little bit of a scare because Facebook went on a tear. Now, to kind of recap our positions. First one I want to talk about, the main one here, is Facebook. You'll notice that we have a credit call spread here, which is a bearish position on Facebook, and we had rolled into it. If we take a look at our history, I'm going to go ahead and roll this up to our current quarter. We'll take a look at the trade that we placed a few weeks ago. So this was on February 8th. We opened this up where we went and we sold the 165 calls and bought the 175 because we were feeling pretty bearish at the time, even though the stock was trading around 167. We opened this up. It was $1,000 in margin for a $439 credit. So about a 1 to 2 risk reward there for something that was already pretty in the money. At the time we opened that trade up, the goal was just for the stock to stay below the 167-ish it was trading at the time. And as time went on, we were able to do some trades to roll that. The first thing we did was we rolled down our 175 to 170 here to reduce our risk. That cost us $54. And then in addition to that, later on, we went and we rolled down our 165 short from March 15th to 162.5 because we had attained most of the credit at that point. Unfortunately for us, the stock then kind of went on a run. At this point, it was trading around 162 to 163, and it ran up to, really, it was over 170 this week. And in fact, even if you take a look at the move, you can see it opened, or it closed yesterday above 170. So we were pretty fortunate to see a nice down day today. I'm still a bit bearish on it, but I'm not bearish enough for us to stay on the trade. And I think today what we're going to do is we're probably just going to go flat across the board on our book. But this is the position we're in now. So the good news is net return, right now we're up about $127.40 on our Facebook trading overall. We did lose a little bit of ground here because, as you can see here, when we rolled this trade to collect the credit here, the net credit we collected for this to roll down to the 162.5 was about $110. And then it's going to cost us this to close out. So you can see this is obviously a little bit of a loss on that particular roll, but of course we're looking at it from the overall strategy perspective, and we're up a bit, which makes me pretty happy. So and again, because we have this position here, we have this call that we had rolled into as a hedge a long time ago. It is virtually worthless. All the options we have are expiring today. So all I'm going to do is I'm just going to try to close out this call. I'm going to see what the best we can get for it is. I'm going to ask for, see if we can close it out at 360. I think maybe if we push that out there and we let it kind of sit, it may get picked up. Oh, it got picked up immediately. Probably should have been a little more aggressive on trying to close that lower, but it's all good. We wanted out, we got out, and we will let that other call. We'll probably just let it expire because I don't think we're going to get anything for it. I'm sorry for the call here. I don't anticipate, at least, that we'll get anything, so we'll just have that hang. So now we're effectively closed out of Facebook. Teva is another one we were bearish on. This one we're at virtually full credit for. There's a little bit of cash hanging out there because we were short this 16 call. There's that $4 in theory. We're going to let these both expire though, because they will run out. And you'll notice the markers we have here on our portfolio. They give us how many days till expiration, and then the percent likelihood at this point of the option closing in the money. So as we can see, it's virtually zero here, zero, almost zero. And then if it is something we have to worry about because it's in the money or high risk of in the money, you'll see a little red warning here. And if it's something that is likely, but maybe not 50% likely. I think we generally use the 10 to 30% mark. We'll put it in yellow here to give you a warning about that. And that's if you're within a week of expiration, just to kind of give you an idea. So in this case, we can see this is an option we're going to want to deal with on Carnival. So now that we've got Facebook out of the way, we'll talk about Carnival next. Carnival, we've got these puts at 58. It's very likely to be exercised. I mean, it's a virtual guarantee as the stock's trading around 57. This has been something we've actually had pretty good luck with. We've traded Carnival. As you can see, we're up $365 on our total trades. We traded two specific trades. And I'm trying to see here if there's a good way to lay this out. It's better for us to just look at the trades. I mean, we have the short put that we're in here. This is a trade that we're slightly down on overall. As you can see, we sold the put, we rolled it, we rolled it. It was trading, we've been kind of chasing it, looking for some profit in this 57.5 to 58.5 range. Um, Unfortunately, it's kind of been down a little bit from when we first got into this, which was 58 and change. Now, as a small point to bring out here, they did issue a dividend. I don't recall what it was. I'm going to guess it was around 25 to 50 cents or so. And so that means that the underlying stock, adjusted for this date back then, should be down around 25 to 50 cents. But net, when we close this out, this is mostly probably liquidity right now. So if we go back to our portfolio and we try to close out Carnival, if we can get a price, if we can buy it back for something closer to that lower end, make sure I got all this lined up as I rush through it. Yeah, we're buying to close, debit 1, fine. If we can close this trade out at $1, then I think we'll end up positive on the overall trade for that. So we'll let that hang for a little bit there. And so we closed that. So Facebook's effectively closed. We got Carnival. Microsoft. So this is an option we sold. Microsoft's been really good to us. If we take a look at our history on trading Microsoft, we can see that if we go to just the current quarter, yeah, Microsoft's helped us bring in over $1,000. It's been a stock that we've been bullish on. Now, if you'll notice, when we first started off, we were bullish on Microsoft, and it was trading at the time. It was trading, I believe, around 105. That would have been where it was if we basically brought it in at 105, if we did a covered call there. So being up at 116 now means that we've seen about a 10% rise in the underlying stock. I am still bullish on it, but what I'm going to do is I'm probably just going to hang out at this time and just we'll probably just close this out or let it expire. We've made a bunch, but right now I think we're going to go flat book for the time being. I haven't really done much research over the past week or so in terms of investing on this book, so on this portfolio. So as a result, I don't want to just randomly go out and roll trades or find new trades. We will do that, but we're going to take a little bit of a break probably for the next week or so and not get into anything. So again, we're going to let Microsoft expire, and we're going to let Teva expire as well. Teva's been a nice trade for us, got us that full credit. This is a trade we did a little bit of management on. If we go to our performance, this was one that when we check out the actual details of the trade itself, we sold a call spread, 17-19 call spread, when it was trading at around, at the time here it was kind of bouncing around because of it was right after earnings. As you can see, the low that day was under 17 and the high was above 18, which is a pretty substantial range. I think it was around 1760 or so. That's from what I recall, and the tools told us this was the right trade to make for the view that we had, which was just we wanted to profit if the stock stayed flat or went down. We were basically betting against the stock surging forward after a disappointing earnings call. And all we really did was about 2 weeks ago, we made one roll, which is we pulled in this call that we were long, which was hedging it was hedging our short call just to avoid the risk. We pulled it into 18, so it cost us about $45 to buy some insurance there, or at least to minimize the risk we had on hand. And so we were pretty fortunate in that because of that, at this point, the stock continued to drop, and now we're looking at full credit for this by the time everything settles on Saturday. So that's kind of where we stand right now. The only thing outstanding is this one Carnival trade. And I did want to call out one other thing on Facebook that we did. We had, of the trades, when we get into our bearish call spread, we had one other thing we did here. Very early on in that trade, when we opened it up, this was, again, a bearish trade. It was 165, 175 for calls. So because it was around 167, we wanted it to go down. When it did go down, you'll see it was really trading in the 161 range, 161, 162. The thing we did, which was only 2 weeks later, was we rolled down the 175 to 170. And that was it was a cheap move at the time, right? Because we had collected $440 in credit. We went and we spent $55 to roll down the 175 hedge to 170. And what that did was it cut in half the potential loss we could have seen. Actually, it didn't even cut it in half. It did way more than that because we collected $439 in credit on a $1,000 margin requirement, which meant that we were putting up about $561 of our own in order to protect against that. When we rolled this down for $54, it meant that our credit was now about $390. So we had collected at this point $390, but the worst we could do was have to then make up the other $110 on our own. So we turned this trade from being a, roughly, 4 to 10 risk reward, or rather 4 to 6 risk reward, to one that was a 3 to 1 risk reward. So we were able to drastically reduce the margin we had on the line and give ourselves a better opportunity to make profit there. And I just want to call that out because the tools that we provide here are really intended to help you manage these books. So for example, the trade search, the screeners, all that stuff we have, like that's all really effective for entering positions and looking for stuff. But if you already know how you want to trade, or if you already have a position open, a lot of times it's managing the book that's more important. So if we just take a look at this Teva trade here, and we go into manage the book, you get the view of what your P&L is for today. As we can see here, it's pretty obvious. But if we decided we wanted to keep this trade on and we just wanted to roll it out till April, so we'll go to the April monthlies and we'll take the 17, and we'll do the same for the positions we're long covering them. So April here, and we will go to again we'll go to the 18s here. Being able to analyze not only the difference in the profit and loss, so we'll move this forward and saying, okay, this is what our P&L looks like. Here's what the probability is that we're looking at a gain. Here's the implied distribution for the date we're looking at. Here's the simulated returns. Like right now, we're virtually guaranteed to make $4, or at least our main is a little under $4 because it's virtually guaranteed. And here, the mean return, again, every trade you open fresh is probably going to give you a slightly negative mean return, but it's a very high probability of gain. So again, if you have that bearish view, you'd want to do this. We could see the distribution. These are the every 5%. So if you were to stack rank your potential returns into a histogram here, this is the 0 to 5% worst case, and then here's the next base case up and next case all the way up. And the relative size of the circles tell you the relative size of the returns just as a quick at a glance. So you can see, for example, here, this is where we cross over from losing to gaining money. So it's yellow and it's relatively small compared to this huge red one, meaning that that's relative to the entire circle, the amount of gain or loss we have at stake. We can also see our updated book as well as all the metrics around the book. So we can see if we were to make these transactions here, roll this out to here, roll this out to here, then we would end up with a change. Our current book value is $4 in market value, but we would be at $100 in credit. We would see a maintenance margin of $400 required. We would be up $88 in cash. Our delta would be changed. Even our portfolio metrics are here. And so this is an important part of the tools, is being able to manage the positions that you're trading into and out of. So we'll come back out here. I see Carnival hasn't closed yet, so we will do the less than exciting stuff here. We're going to change the order. Kind of a bummer that our bid is the limit for one contract, because that means we're going to have to move up quite a bit here. So let's go to 105 and see if we can close that out. We'll give it about 5 seconds here. And then we will cross the midpoint. See if we can't close out at midpoint. Next step will be going up to 110. I'm guessing that they must be dropping, and plus the liquidity is not going to be great at the end of the day. So we'll just kind of chase it down until it closes. At this point, I bet if we were to offer 111, I suspect that would probably close, because this is, at this point, this bid is us. Oh, actually, Maybe we have to do 5 cent increments here. I mean, it's just the one order. It's only a few bucks for us to actually pay what they're asking. And we'll let it hang at the bid for a sec, and we'll see if that doesn't fill on its own. Take another look at our portfolio. So this number here I wanted to call out. This is pretty much out. This is our all-time high, which is nice to kind of go out here on a high for today. We're up a little over 6%. This also includes all of the transaction fees, so any of the assignments and exercises and stuff like that, as well as the $99 a month for Quantcha Unlimited. So, you know, all the trades we place today, if you have partial trades and you have to replace them and put in a new ticket, you don't get any per ticket or per contract commissions attached to you. It's just straight up, you know, you pay 99 bucks a month, you get all our tools, you get all the trading you want. And so being out there, and then finally, since this hasn't quite closed yet, let's just go. We'll put it in. This might take a moment. I mean, being a limit at the offer should close. Oh, there we go. Filled at 113. Go figure. So I guess that goes to show we're getting a little bit extra value here. And so at this point, we got 4 option positions remaining. I mean, they're all virtually guaranteed to expire unless Teva comes up with some huge end of day run, which hopefully will not be the case for us. That should kind of settle us up here. And so I'm going to wrap it up here. Next time we connect, we'll have done a bit more research on my end to make sure we have some stuff to trade. If you have any questions or comments, of course, you can always leave them here on YouTube, or you can hit us up at hello@quantcha.com. In the meantime, I hope everybody's taking advantage of the nice little run up in the market. And as always, good luck and good hunting.